Okay, so just briefly about myself. My name is Jan Strans-Renslats. I'm one of the counsels from Sorainen Law Firm, which is a pan-Baltic law firm, a fully integrated one. We call ourselves leading law firm, but of course there's many leading law firms in the Baltics, but we're just one of them. What I also do is I lead the Latvian sector group for the startups here in Sorainen. So I deal with a lot of these issues and deals on a regular basis. So if there is anyone from Sorainen team to speak about these topics, then probably I'm one of those people, and I'm happy to be here today and share that information with you guys as well. I think Andrew perfectly encapsulated the whole message about the next part of the presentation as well. So valuations is a very, very, very important topic, because we can't really talk about exits before we actually delve into valuations as well. And I think this quote kind of encapsulates this predicament as well. An investor without an exit strategy is basically like a taxi driver who just doesn't know where he's going, and the meter is always running. So there must be some kind of a concept of where this particular investment might end up, and how you are going to exit from that specific investment. So about the presentation, so I would like to briefly focus on the mindset, because I think that's something that was also covered today, but it's very important to reconsider it over and over again during your, I would say, experience as investors, because that is something that will always come back and torment you in those situations when there are really bad investments, and you will try to think, why did that happen? So I think the framing and the mindset is a very, very crucial thing for angel investors. Then we will step into the valuation process, and then we will finish with the exits and some of those good scenarios that you are all looking forward to. So what is an angel investor really? So I think at this point in the training process, you guys already know something about who you are and why you're here, right? But just to kind of segue back a little bit, so who you are, you're high risk capital investors. So basically, you're there to invest as the first ones in those startup ideas, and you're the first ones, I would say, the earliest believers in the founder's idea, right? And the founder's vision. And also part of a chain. So basically an angel seed Series A, B, C, and hopefully somewhere at the end of it also an exit. What you are not, of course, you're not a bank, so you're not like, you will not be able to, as we touched a little bit upon it before, you will not be able to return if something goes south, meaning that if the startup does not really do well or just bankrupts, most likely you will not be able to get that money back. You're not a passive spectator, meaning that it's very important for you to be part of the governance, meaning that you're able to observe what the management board is doing, and you're actually taking part of the company's life. And to end with it, of course, you're not guaranteed to get anything back. When we think about the fundamental mindset of investment, this investment mindset, we need to think about it from this so-called power law perspective, meaning that it's Pareto law, right? So as Andrew also mentioned, that most of the times the investments will fail. Pareto, I wouldn't say Pareto probably, because Pareto is like 80-20. Most likely it's less than that, meaning that even less investments will actually return something than it's usually in the Pareto law. And if you focus on the job of an angel, just to kind of continue with the mindset, of course you must be in the room when those deals happen. You have to be in touch with the founders, with the people who are actually doing something to make the capital work. You have to write the checks with appropriate size, meaning that you always have to take into account what is your limits, what is your risk appetite for those specific scenarios. And of course, not panic when 70% of the portfolio looks bad at year 3, which is not typical, which is quite typical, I would say. I think this is a very good quote that encapsulates this mindset of angel investors, that venture capital is the only industry where you can be wrong 8 out of 10 times and still be considered really good at your job. So this is something that you need to keep in your mind and understand that this might at some point be and look like this.
So sorry.
Yeah.
Just about that Pareto or power law, I think it was Geertz in some previous sessions who said that it's not like that half of your investments still return a bit, but not exceptionally well. So, and you say that it's more like
yes, it's a good point. Of course, it's a good point, because what I'm trying to say is that we need to focus on the mindset. So the mindset is that you should be really willing to lose more than 80%.
Okay.
So then it's kind of like it kind of prepares you for those really bad situations along the way, meaning that at some point in your investment career, you will feel like, oh man, this is really going south, but it might not be that bad at the end of the day. But it's something that you need to keep into account and account for in the mindset kind of framing perspective. I think we can skip this because I'm perfectly focused on what's happening in the Baltics context, and I think this is more of a general outlook because yesterday a KPMG Pulse report came out, so it was possible to actually pull some data from what's happening in the last quarter in 2026 as well. I tried to put some of those data points in the presentation as well, and along the slides you will see some references to specific reports and some specific data. But all in all, I think we all know that Baltics is a small market. We are only about 6 million people, but we are home to a lot of unicorn companies. So the percentage-wise, we are in a really good ecosystem, meaning that there's quite a lot of unicorns for the density per capita, to say so. So it's a good time to invest. Of course, 10 years before it was better time to invest in the Baltics, but still we're in a good market and we're doing well. And even not in the Baltics, but in general around Baltics as well, we can see there's a lot of big companies that are doing well from, for example, Scandinavia. This first quarter, Lagora, for example, raised well in total 550 million. So it's a big market. It's a lot of things are happening, and it's really cool that in adjacent markets to Baltics as well, a lot of things are happening. So it's a good time to be an angel investor. It's a good time to try and capture those specific scenarios where you can make some money as well. These are the data that I mentioned, so we can see a lot of interesting aspects. And I think one thing that I also wanted to emphasize, which I think is a good segue from Anders' presentation as well, is that we can see a lot of AI penetration in the market, meaning that there's a lot of investments related to AI companies. And for example, in UK alone, there's about 3,000 VC-backed AI companies at the moment, which is it's a crazy number, to be honest. And if you look at Germany, for example, there's almost half as many. So meaning that the UK market is just like booming at the moment, and more than 61% of the European VC deals are in some way related to AI companies at the moment, meaning that this is the big boom. Where this will take us, no one really knows, but we can clearly see that there's a bubble and there's a lot of interest in it. So maybe that's something that you should also focus on and see what's happening with the reports and information coming in and analyzing that for a deeper understanding of the markets and the trends. But this is by far the biggest trend at the moment. So to the valuation, why valuation matters. And I think it's a very important point because we can't really talk about exits before we actually talk about valuations. It's not really a founder's problem. And I think we heard that before as well. Founders have their own expectations, their own imagination, what their company probably is worth at the time of investment. And but at the end of the day, it's your problem more than theirs, because you are the one who's investing the money, and you have to have some kind of understanding where the exit, when it comes, can take you and how you can actually return that money that you have invested. Meaning that you have to be really good at evaluating companies. And sometimes, as Andrew also mentioned, it's very tough because there's nothing to evaluate. So you're in that big limbo where you have to evaluate something, you have to come up with a number, you have to kind of put it in perspective, but at the same time, there's not a lot of information to go by. Well, let's try to focus on maybe some of the things that we can look at and try and evaluate some of the companies that you might meet in the upcoming months, years, or decades. Just for a simple numerical illustration, I think is this completely understandable to all of you? If you look at the like a simple investment numbers, right? Okay, let's skip that. So it's I think it's very basic, but just so understanding that the valuation is crucial, because depending on the valuation, the returns will also be impacted. So it kind of looks like a simple and the same investment, but just because of the valuation at specific times in time, we can see that the ownership share share ownership for the angel is just way more different, and it also impacts the exit at the end of the day when the company sells. I think it's these 5 points are really crucial to kind of emphasize, also for the mindset, also for the things that you need to look at when you're trying to evaluate companies. And I would say the 5 core challenges would be that, of course, there's insufficient data. It's very hard to look at something that there's just no data about. There's no actual turnover. There's no actual market data you can use as a metric for specific valuations. There's very uncertain future performances because the markets are volatile, mostly when you invest in some new ideas and new companies. There's lack of comparables, especially in nowadays when we look at this AI time. There's so many ideas, and all of them are trying to pitch them as something that's completely new, completely unseen before, and it's hard for the investors and also for the angels to really try and look at it from the perspective of something already existing. There's also a lot of bias and subjectivity, of course, which sells, especially in terms of how we as humans perceive information, how we look at it, how trusty are the people, how we trust them as well. As Andrew also mentioned in several occasions, that you don't really know whether they bluff or not, and then how to account for that. It's of course a human decision-making problem that we need to solve. And of course, there's also a possibility for multiple funding rounds, meaning that it's very hard sometimes to track and follow all the information that comes afterwards, also after your investment, to understand where you're at, how does that impact you as an angel investor, and what would that possibly mean for your investment in the future. So it is quite a tricky situation, especially when you have to account for that at that very early stage. When most of the times the narrative and how it's sold in the public plays way bigger role than the actual numbers behind that specific company, specific idea that's being sold to you. So, of course, this is more of I would say, it isn't really a blueprint. There is no blueprint for valuations at this stage. So, but this is more of a guideline, I would say, that you can look at and use to kind of try and look for a specific valuation that you agree upon when you need to do that. So there are different methods you can use, and of course, at different stages, those methods become more and more relevant, I would say. For example, at Series B and Plus, you can easily use discounted cash flow method, for example, or First Chicago method, but you can't really do that at pre-seed because there's like no data. So of course, you have to backtrack a little bit and use something that's more simple, I would say, such as Berkus or a scorecard or a VC method. So I will try to briefly explain how all of these work. It does not necessarily mean that you have to use them every single time, but this is something that you can use to kind of challenge what the valuation is that the founders are also putting at the table and trying to sell to you at the moment when you try to invest in it. So it's something that you can use just to check your own judgment, see where you are, whether you're comfortable or not. It does not necessarily mean that this is something you always have to do and this is the right way to do it. There's no right way to do it. Every single person does it differently, and that's why there are a lot of funds that make a lot of money. There are a lot of funds that don't. So it's back and forth all the times. But just to kind of give you a glimpse in what you can use and what you cannot use at specific times, this is, I think, a good summary. So what is the Berkus method? So I think it really simply put, it focuses on the qualitative assessments and the early indicators of potential rather than the actual metrics. And one of the ideas is that you can just assign a value to 5 specific factors, and the value can be up to, like, I would say, $500,000, for example, for the idea, for the prototype, for the quality management team, strategic partnerships, and this is meant by something that they already have, an existing partnership, or market potential, for example. And a quick example for the use of it would be that if there's a Latvian business-to-business software as a service company, pre-revenue, solid team, they already have some kind of a product. The total Berkus valuation could be about 1.5 million. If the founder asks at the valuation stage for 3 pre-money valuation, of course you can easily challenge it because it doesn't really add up to your own valuation at that point. So it's a way how you can put a number on something that you can't really otherwise calculate. So the scorecard method, it's slightly different, but it kind of compares startups to a similar startup at that same stage when they already had some kind of an investment. It's very simple in terms of how we also assign those values, for the factors are quite the same. 5 key factors are the typical. So there's a strength of the team, which is most of the time is the most important one. Size of the market, product and technology, competitive environment, and sales traction. So what you do is you have some kind of a weighting for that specific criteria, such as, for example, 30% for the team, 25% for the market, 20% for the product and technology, 15% for the competitive environment, 10% for the sales traction. Then you rate that for that specific company. For example, I don't know, score 8 of 10 for the strength of the team, 6 out of 10 for the size of the market, 9 out of 10 for the product and technology, and 5 out of 10 and 7 out of 10 for the remaining criteria. What that gives you is later on you can just come up with some kind of a weighted average score for that company. And if you weight the average score for those 5 weightings, it's about 7.15 because, for example, just to kind of give the math, so like 30% for the strength of the team. So if they would score 10 out of for the first criteria, they could get like 3 points, right? So if it's scored 8, they get about 2.4, right? So if we add all those scores up, we end up with something that's about 7.15. And if we know that there's a similar company, and again, what is a similar company? You don't really know, but still at least something, right? And you know that they're valued, for example, at 2 million. You can use that weighted average score to kind of see what the valuation could be for this company as well. And that would be the score against that previous valuation, 1.43 million. So again, a simple method, but again, you can use it just to kind of fact check what's happening and fact check what the founders are asking you in terms of their own valuation. I think Andrew also emphasized this, and I couldn't emphasize it more, that in Latvian sector as well, and not only Latvian, in the Baltic sector in general, a strong team is what actually justifies higher valuation for the company, because we know that if there is a very strong team that has raised money before or have been successful with previous companies, they have a really good track record, meaning that we can also add some additional value for the company and kind of account for that as well. We don't really have to follow all this just from the mathematical perspective. It's just one element of this whole equation in some sense. So anything that can help you to kind of fact check yourself and give yourself a feeling that you feel comfortable, it's fine, and it's good to use it. And of course, the VC method, which is basically something that we can explain as a backward calculation from the exit, which is maybe a bit more complicated, but I think we can go through this, and if needed, or is this something fresh? All right, so I'll try to maybe go through it as well. So you're trying to focus on the expected future exit, so the value to value the current valuation at the time when you need to determine the investment. So in step-by-step kind of analysis, well, let's take, these are completely made up numbers, so it has nothing to do with the actual market, but just like a really good example of how to easily calculate that. So the first estimate the exit value, so based on comparable company valuations. Second, determine required return. So usually VCs aim for a return of 3 to 10 times, right? So over a 5 and 10 year period. And third is calculate pre-money valuation, discount exit value to present. How does it look like? It looks pretty simple. So for example, if you have like a year 5 projected annual reoccurring revenue for the company is 5 million. So subscriptions of the company is about 5 million a year. SaaS exit multiple is about 4 to 5 times, so the exit value could be about 22 million for that specific deal, right? If your target return at the investment is about 10 times, we can imply that the post-money valuation of that company at the time when you make that investment could be about 2.2 million. If the founder asks 5 million at that stage, of course the math doesn't add up, so it means that they're trying to value it way too high, and you can again fact check it against something that how it will look like at the end of that specific investment at the end when you try to exit. Again, another method you can use and just to kind of fact check what's happening in your own mind. I think this is something that Andrew covered really well, what the VCs are looking for, so I'll skip that. Maybe something that I want to slightly touch upon as well, because it affects the exits as well, and it's a very important aspect to it, is the down rounds and the dilution as well. Andrew mentioned down rounds, but I think one significant aspect of it is that down rounds happen quite often, so it's a big risk, and you really have to take this into account, right? So it's about 25% of the financings in 2024, and that's from US data, were down rounds, meaning that there was some kind of dilution that wasn't really cool for the investments, right? And if you invested 5 million pre-money at the next round, if it's a down round at 3 million, you are underwater already. So it's a tricky thing that you need to always account for that it could happen. So it's a big risk, I would say. Dilution, I would say that this applies to the dilution part of the of this slide. It's not as bad as it sounds, meaning that I'm not sure about how this, like from the beer perspective, probably it's really bad, but it's not as bad as it sounds because it's inevitable. If the company is going to raise money and become worth more at next round and next round, next round, it's inevitable that you will be diluted. It does not necessarily mean that you will lose a lot of money out of it. It's just a part of the natural equation that will happen. And what you need to account for is at least 3 dilutions if you're looking at exit at Series B or Series C, for example. You have to model this from day one. So that's one thing that you can take away from this is that you need to model this in your equation for that exit strategy that you have when you make that investment. Okay, this is, I also skipped because we already covered that anatomy of the deal. I think we can cover that as well. Practical exercise, I think it's something similar than before, but let's look at it. So just to kind of give an example how use of both methods can kind of fact check yourself and again, completely made up scenario, Latvian business-to-business software as a service company. It's 2 years old, 120K annual reoccurring revenue, growth rate 100% a year. 3 founders seed round asking for 500K at 4 million pre-money valuation. So according to the VC method, and this is very, very, I would say, rough, and I would say also it's very, very, very high expectations of success. I would say that. So because at year 5, the valuation of 5 million, and reoccurring revenue, it's quite impossible. It means that the annual growth rate must be higher than 100% every single year. Because if it's going to be only 100% every year, year 5, it's somewhere closer to, I think, 4 million. So 5 million means that this company is just growing every single year more than 100%. So it's a very, very rough estimate and very, very optimistic, I would say. But anyways, again, if it's a SaaS exit multiple about 4 or 5 times, then the exit is about 25 million. So in the middle, so 22 million. Dilution, as I said before, 3 times each round. So you lose about 60% of the original share. And your target was 10x. Max post money, so it's the valuation is actually about 1.3 million, and if the founders are asking 4.5, then it's about 3.5 times above the actual what the method justifies. So for this scenario, their request for 4.5 million is just way too high. And if you fact check that with the Berkeley's check again, remember, like we afford a specific value up to 500K euros for specific criteria. If you add those up with specific, this is made up, of course, scoring, but still, if you add those scorings up, we can see that the total is closer to what is consistent with the VC method as well. So again, both methods can be used just to kind of calculate something about this one specific company. And again, this is no financial advice. This is just a very, very simple, I would say, example how both of these methods can be used. Yes. I think the one thing I would like to emphasize in relation to this, that of course valuing companies is not just the mathematical exercise. It's really quantitative and qualitative analysis. And again, I think we need to stress this as much as possible. A passionate founder with a credible team is the actual goal that you're looking for, because they can really solve the problems rather than actually end up with something that they can't really solve just because they're not talented enough for that specific problem to be solved. And it's a big problem. Of course, it's rare as well, but we're trying to look for them and try to. Yes, please.
Yeah, actually, back to the dilution part. I mean, speaking quite a lot about it also in Anders' presentation, about the rights to actually invest in the next round.
Pro rata.
Yeah, pro rata. Must have, right, in every single
Yeah,
investment
but it's also I would say it's a typical thing to have in both in the term sheets and both in the agreements as well. It's not something that's very unheard of. It's what usually it's a market standard, and in both in not I wouldn't say both. I would say in all three Baltic states, and to a certain degree, it's also something that the angel investors are using quite often. So of course, it's harder to do it at later rounds, but at the first couple of rounds, it's something that the angels are always trying to do, to kind of maintain their own shareholding. And of course, if they're not able to do that, they just baby it. So it's not a big issue. And to have it in the contract, of course, is a lifesaver sometimes. So how do you actually get paid? I think we are slowly getting to the part where we're looking how to convert that investment into money. And there are many ways, of course. I would like to focus on three primary ones, the three ones that are most topical for angel investors, I would say. And first of all, it's the M&A, some kind of M&A activity, meaning that it's also the most common in Europe and globally. Second, of course, is the IPO, which is the big thing that everyone really hopes for, but let's see where the Air Baltic thing leads us to, and maybe after that we have something more interesting. But jokes aside, that's also something that we try to look towards. And in the US, it's a big thing, of course. I think in Europe also at the moment in 2026 first quarter, the biggest exit was an IPO in Norway. So it's I think it was Norway. Yeah, sorry. Yeah, but yeah, so it is something that happens, but not that often. So it's probably not the thing that most likely will happen in your experience sometime soon. And the third one is the secondary sale, of course, where you sell your shares to some other investors. So which is quite common as well. And we see from the market data that it's a very big market at the moment, not only in Europe but globally as a whole as well. At certain points in 2025, the secondaries market was actually bigger than the IPO market, VC-backed IPO market in the world, which means that there's a lot of interest in secondaries, and it's a very good exit as well. So by definition, let's look at the first one. So just an M&A deal. So basically, a strategic or financial buyer acquires the startup. You receive cash proportional to your ownership after the preference stack. Typically 5 to 10 years from angel investment to acquisition, and in the Baltic context, well, maybe just an example, Baltic Tech M&A typically occurs at 5 to 50 million, and which is a modest, of course, European standards, but still for our markets, it's a big thing. Legal mechanics. If we look, there are a lot of different mechanics behind, because not one M&A deal is the same, and I think you all probably have some kind of experience with M&A deals before, or have anyone had any experiences with sales a company? Right, Andra? So yeah, so at the end of the day, not all of them are the same. There's always some kind of a nuance to the specific deal, and many times, well, I would say even oftentimes, especially with the startups, those nuances are very wild, meaning that they can go from, the range is just, it's a big spectrum of things that can happen, and big spectrum of people who are involved, big spectrum of the investors who are involved, the ideas, and also the founders and how they correlate with that, the depth that is also a side of it as well. So there's a lot of interesting things that can happen, and every single one of them is a different. But in really big terms, there's always some kind of an escrow that's being set up, so just to kind of typically save some money before it's paid out to all the investors, just in case if there are some liabilities with that specific deal. Because when you buy something, of course, there's a big legal due diligence where you try to look for specifics that are good or bad with the company to also come up with some valuation and the deal. But there are always some kind of liability caps and liabilities encapsulated in those deals, meaning that if something wasn't as they were presenting that in the due diligence, or there was something that was hidden, or maybe there was some other issues with the company, you can still kind of account for that and mitigate the factors by that escrow that's being set up and to hold back those funds and coverages. There are some earn-out provisions that are quite possible, meaning that sometimes the founders, they are not allowed to completely leave the company, or they have to be they have to stay with the company, meaning that they will have to earn their part of the deal as well, meaning that otherwise if they leave, they can set up something really similar or whatever competition. Yeah, for example, yeah. So competition aspects aside, of course, because there's a lot of non-compete provisions and whatnot in the deals. But anyways, when you buy the company, oftentimes you want that founder, you want that leader, CEO, even sometimes, to stay with the company and earn his part out by years, which is typical, especially in digital industries. And of course, the drag-along rights, meaning that the majority can force you to sell alongside them as well. Oftentimes, angels are not, well, I wouldn't say oftentimes, most of the times, angels have very limited, I would say, influence in how the deals are being structured. Of course, you have some influence, especially when you group together and you have a single, I would say, representative that tries to encapsulate all the investors behind one specific goal. But oftentimes, majority investors are the ones who are calling the shots.
Can you also briefly mention about tag-along rights, because we haven't covered that?
So tag-along, meaning that you are allowed to tag along, meaning that if the company is being sold on specific terms, that you have the same right to tag along with those specific same rights as well. So you wouldn't be left behind by not getting any money because the company is being sold, but you just stay with the company. You're a dead share as well. So tag along allows you to tag along with the deal. Drag along means that they just drag you along and there's no option. So the big wow, of course, the IPO, the glamorous one. The company lists on the public stock exchange. Private shares become publicly tradable. That's the big thing that everyone wants to go. And yes, the biggest one this year, General Ocean's IPO in the Euronext Oslo stock exchange, 3.5 billion, which is it's a mega deal for Europe, which is great. Some data from the what's happening with the IPOs now. This is pulled from, I think, KPMG and the PitchBook, both of them combined. So there's a lot of listings. There's a lot of big deals happening, especially in the 2026 first quarter. And the kind of expectation for the market, what's going to happen, and how they try to evaluate what's happening in the market, specifically in Europe, is that it seems like that there are about 72 companies in the AI IPO pipeline, meaning that there are at least 72 companies in Europe that have been identified as potential IPO candidates in Europe alone, which is, of course, a big number, meaning that the AI industry as a whole is a big player at the moment, and it's a big boom. For Baltic Angels, of course, all POs is not that realistic, unfortunately, because we're not that mature in the industry at the moment. We saw from Anders' presentation as well, there was one exit last year, a couple on that, so basically 3 altogether. So we're not in the market where we look for these as the things that will happen most likely. But anyways, this is something that everyone hopes for, and at some point, hopefully, you will all also have a chance to taste something from the IPO. From one of your investments. So what I still wanted to emphasize about the IPOs, I think it's a good saying, and it kind of goes to everything, I suppose, in venture capital industry as a whole. Timing is everything. Yeah, how you time the specific moment where you enter the market, how you time the specific valuation. You can hit really good, or you can lose really bad, and I think this is a very good quote from Ika Paananen, who's the founder and CEO of Supercell. It's a Finnish company. An IPO window is like a good summer in the Baltics. When it comes, you had better be ready. You cannot manufacture the weather. I think it encapsulates this whole timing is everything idea really well. Of course, we have to be ready when these things happen, and it's amazing when they happen, but you can't really predict them. So it's just, it happens. So the exit route number 3, the secondary sales. So you basically sell the shares to another investor. The company does not need to be sold or listed. Why it matters now, as I said before, at the moment, secondary market, and that was also throughout 24 and 25, this is US data. I think it comes from Krabath, which is a law firm. They also really focuses on specific niche investments in markets. But anyways, at certain periods in time, the secondary market was valued higher than the actual IPO market, VC-backed IPO market, meaning that it is a big market. There's a lot of money and there's a lot of interest to buy out specific investments with the secondary. So it's not that there's only the M&A as a sale of company as a whole or the IPO. There's a lot of chances for you to sell the company, your share, for somebody who's really interested to get that part and kind of combine it. Yes?
Actually, I have a question. I have no idea the answer to it. Let's say if there's an angel syndicate in, let's say, a considerably mature startup that's already, let's say, doing quite good, but you don't see the exit route just yet, can you request the founders to consider these a secondary sale? Like, can you, I don't know, legally push them to?
Everything comes down to the shareholder agreement, right? So at the end of the day, what are the rules of the game are set in that shareholders agreement. And oftentimes this is something that happens. Of course, you can try to push the founders, and I think, as Anders said before as well, that oftentimes in the past, there were a lot of angel investors who were like really, really pushy towards some specific things that the founders need to do. It's nowadays not that common, but still, of course, you can try to push them, invest money, efforts, and whatnot to maybe persuade them to do something with that specific course of action. But you never know how they will, of course, respond. And oftentimes you don't really have, I would say, a clause or a provision in the contract that you can actually push them to do it, meaning that it's not legally binding. There can be some mechanisms that you can employ to put some pressure or whatever, but of course, when you start to really be more of a problem and an obstacle for the company to grow and develop, and you kind of start your own conflicts with the founders, it's not going to end well for the future of the company. So it's not often what's happening.
If I can just add to this, so what we are seeing in the market is that some funds put in a clause that if within 7 years no exit happens, they have the right to appoint M&A advisors and to start looking for ways to exit the company. So, but this is for investors like VC funds, because typically they have an 8 to 10 year time period when they need to exit. I think with the angels it's a bit more tricky to put such a clause in.
Yeah, and I think the founders would not be really comfortable to allow something like that. I think for them it's harder to do it because with the VC funds, they come with bigger money, bigger numbers. They have more power to actually get those really, I wouldn't say those are particularly aggressive terms, but those are terms that I would account for more on the aggressive side of it. With the angels, it's harder because with the angels, you have to be friends and friends with the founders and the company. And it oftentimes does not really look like that when you start investment with the company at the early stage. But anyways, to segue back, the secondary market is a big thing. You should always look at it because oftentimes selling before the end is sometimes the best thing. And sometimes it seems like secondary is always the second best. It's sometimes not the second best. Sometimes it's the best option for that specific period in time. And it could actually end up better than by sticking with the investment until the end when you maybe make less or don't make anything. So yeah. Again, for the secondary sales, maybe some legal mechanics, but again, all comes down to the shareholders agreement. That's the rule of the game, how it's set up, but all the usual things are still important. And I think what encapsulates this whole idea and the conversation about why you need to focus on the shareholders agreement is that having found a buyer for your shares is wonderful, of course, but when you have to get a consent from 7 other signatures of parties, then it's not so. So you always have to account what is the actual course of action, how you can get to that specific sale of under secondaries, what you need to do that, and if it's even possible. Because sometimes it's just not. There are different rights that are being encapsulated in the shareholders agreement just don't allow you to do that. You have to stick with the investment or even more. And there's some tag-along rights that just don't really sit well with the VC fund or the investor that wants to buy it, and they just don't want to buy that much, for example. So it's not an option. There's many scenarios, many mathematics behind it, but at the end of the day, shareholders agreement is the main instrument that you need to focus and understand. Another one, tender offer, which is, it happens actually. It's not that, I know it says currently rare in the Baltics. It is rare. It's not that, it's not, I would say popular, but it happens once in a while. There have been some deals where a tender offer is being announced, and which basically means that companies buying back the stock from the employees or from specific investors, such as angel investors, at a certain set price. This is popular, and we can see that, for example, the median tender size Series C, this is also, again, US numbers, is at that stage was about 27.6 million, roughly 5.5 times those at the earlier stages, which is a good number, and the companies are willing to pay extra just to get those shares back because they have specific belief that they will use that for their own advantage, or maybe in the talks with the bigger investors for some growth capital or whatnot. There might be different ideas why they do it, but they oftentimes do it. I think another big thing that we need to look at, and this is something that kind of checks back with what is the actual reality of investments, because if we only look at what we want to receive at the exit, that's of course beautiful, but oftentimes it's not really what happens, because the so-called return waterfall dictates the way how people are getting back their money, depending on where you are in that cap table, where you are in that waterfall when the money drips down. And oftentimes, of course, we know that venture debt holders are being paid first. If there is some senior liquidation preference, which oftentimes is with the bigger companies at later stages, later series, which could be 2 times, even 3 times preferred, and the standard in a typical venture deal is 1 preferred in the Baltics, and then only comes the common shareholders. And we look at a really simple acquisition, an M&A deal, for example, at a valuation of 10 million. If there is a venture debt of 1 million, you repay that first, right? So there's only 9 million left for that pot to kind of waterfall. The VC Series A, they had a liquidation preference of 2, for example, on 3 million investment, so they get 6 million. There's only 3 million remaining. We go to the angels, you have 5% from that remaining part, which ends up to be 150,000 euros. At your investment, which is 100,000, your return is 1.5. Although from the outset, it looks that there's going to be a bigger deal for you. So it's just what it is sometimes. So understanding the cap table is also a relevant thing, and you have to kind of count for what this cap table could look like when you invest, but accounting for something that how is it going to look like at the end of the cycle, at the exit. How this cap table could look like when we get to that money, we get to that waterfall, when we kind of dilute it.
Can I ask a quick question about the liquidation preferences? I mean, like explaining the whole like this situation, one might think that, hey, I might want like impose a 2x liquidation preference as an angel already, but again,
it's just a very aggressive term,
yeah,
which is hard to enforce on the founders when you do that. So standard is 1 preferred, and I think it's also typical for the VC funds as well. I think maybe it's just 1 preferred, so it's a market standard in the Baltics. Of course, if there is some corporate venture capital fund that comes in with a big money or a really good offer, sometimes, most of the times, it's a foreign fund, they can try and enforce a higher preference. But in the Baltics, it's most of the times it's just one preferred, which is good for the angel investors. So a typical timeline, and also let's again compare it to what's happening in the US. Maybe it's not the best way to do it, but still it's something that kind of gives us an outlook on how the scene could look like with your investments, because US is way more developed, way more matured, how they look at the startup scene as a whole. Baltics is a small market still developing, but the exit will happen those 7-10 years ahead, right? So the market will be more developed, more mature in some sense. So we can try and kind of look at what's happening in the US now to kind of understand what's happening or might happen at the time when you exit. So the median US startup at the seed, the age of the startup is about 1.5 years. Median age at Series D plus so this is where most of the times you would like to be to exit with really good numbers, is about almost a decade, meaning that it takes almost 10 years for the US market to get to that point from the seed investment to the Series D, for example. So and that's a median age, meaning that there's a lot of times when the age is actually higher, or a lot of times when it's slower. So median age is still 10 years. So it's a very typical timeline. Investment made is the first, second year, company is still building, the second, third year, first signs of traction, or maybe some failures. 4 or 5 Series A, B, first institutional investments, then 6, 8 scaling phase, potential acquirers of interest, and then the exit somewhere in between the 7 and 10, if successful. So what's happening in Europe at the moment? Maybe look at some of this is from, I think from the pitch book, so also very raw data, Q1, 2026. We can see that most of the big deals, and of course these are big deals, so oftentimes that does not necessarily reflect what's happening with the smaller deals, but still we can still see that most of the exits are M&A deals, even at that stage. There are a couple of IPOs, a buyout as well, which is from the Israel side, a couple of IPOs, and yeah, mostly just M&A deals. The European opportunity, I call this slide, but this is just to emphasize why I call it opportunity, is because there is a widening gap between what's happening in US market and what's happening in Europe. And this is most of the times because US deploys significantly more capital and their markets are just returning more capital as well. Europe is just on a different pace. We are slightly dragging behind, but what that basically means is that there is probably better time for investment as well, meaning there is a lot of opportunity for the market to slightly grow and catch those numbers that are happening and are being represented in the US market side as well. Because what's happening in US is affecting all the other markets in the world as well. So although we are dragging in Europe, it does not necessarily mean that we are in a worse position, especially from the angel investor perspective, to invest and look towards those exits in 7-10 years. Baltic specific lens, of course, lower entry valuations if compared to what's happening in Stockholm, Berlin, Helsinki, but also smaller exit multiples, of course. So we don't really get that return on the investment. One maybe thing that to take away from this is that, yes, of course, try to, if you are engaged in some specific investments where you have that partnership in the governance of the company, try to help the company to build that company story from the international perspective. So at some point you can try and sell it not to this Baltic market, but to something that is bigger, something that is outside of the of our interest sphere, and could potentially offer for a bigger deal for your exits as well. So yeah, the best time to invest in Baltics was 10 years ago. The second best time, of course, is now, when hopefully this is really true. That's just some statistics. I don't think it's really important, but maybe some quick references back to what we discussed. So at pre-seed and seed, which is where you most will operate, use the Berkus method, the quantitative scoring. That's seed, maybe the Berkus, the scorecard method. Series A, Series B, of course, there already you have some support, meaningful support from the venture capital funds as well, and maybe that will not be that relevant, but focusing on the pre-seed and seed, those are probably the best ways how to evaluate companies and come up with your own exit strategies for successful investment careers. And that's not investment advice, of course, but just from the general guideline perspective. The 10 Commandments, and I think this kind of repeats what Andre already said, but I think this is something that we need to repeat every single time, just so it kind of lays a very good foundation and understanding and the mindset as well. So entry valuation matters more than exit valuation. You control one, not the other. Dilution is inevitable, so always model that for your exit. The preference stack, of course, can sometimes surprise you, but that's just part of the game. Diversify, meaning that as many investments as possible, at least minimum 10, 15 investments across sectors and stages, so that be sure that some of those will make big and you will cover most of the losses that you will also face. Pro rata rights are your friends, meaning that you have to fight for them. Make sure that those are always in term sheets for you as well. Exercise them whenever you're able to do that, because that allows you to keep the shareholding structure and more beneficial to your side. Drag along and right of first of refusal are also real. Know what you have signed, so really focus on the shareholders agreement and know what's set in stone. And of course the patience, 7-10 years, that's the horizon you're trying to look at. You're not really looking to return the investment in year 2, 3, or 4. This is really a long game, a marathon, I would say. The AI premium, and what I mean by that is nowadays with all that big boom and all the interest in the industry, the AI is really booming. There's a lot of money in the AI companies. Everyone's trying to sell it. Think about whether this is really AI, because if you look at some of those companies, just because they have a chatbot does not necessarily mean it's an AI company. Same as the telephone companies back in the 90s. They had a telephone, does not necessarily mean that they were a telecommunications giant. But really be cautious and really think about whether those AI companies have some proprietary IPR that they need to protect, some proprietary assets that are actually AI related, something that is much more significant than use of specific tools that are being provided by market players such as LLMs and whatnot. And secondaries are not the second best. Sometimes taking 3 times early is way better than not taking anything at all. And well, this is probably a cliche, which I have to say because I'm a lawyer. Get legal advice on term sheets and everything, and hopefully maybe 3 things to take away. Join LADBAN, which is already checked. You have already done that. This is really good. Retain your legal counsel for all the matters that you need to retain your legal counsel to. Hopefully pending for all of you guys, and build your portfolio as big as possible. Minimum 10 investments. Define sectors, define check sizes from different ranges, different risk profiles and whatnot. This is it. Thank you guys for attention. Any questions?
Yes, questions.
I have a question about valuation. Why don't we use some guests from the business plan of the founder?
Sorry? What?
Usually, the founders should have the business plan with 5 years or 3 years with expected flows.
That is definitely something that has to be used. Like, you have to use that information, because oftentimes that will be part of their pitch deck as well. When they come to you, they will have something already made up. They will try to present it, their vision, how this company will develop, what is the market they try to compete in, what are their competitors, how they see getting that revenue in and whatnot. So this will be part of their pitch, their deck, you know. So this is definitely something that you need to take into consideration.
But in valuation, you don't use those.
No, you can use those numbers and figures.
For example, if the company is projecting, let's say, 5 million yearly revenue at year 5, you can already kind of take that revenue and have like the industry multiple, apply the industry multiple to kind of calculate what would be, let's say, at that point in time, the approximate exit valuation of the company. And then you kind of look back the 5 years, is the current valuation justified for the investment? I know if he's asking for a 10 million valuation right now in year 1, and having the year 5 valuation at 20 million, that wouldn't make sense to have like a 2x type of investment growth for yourself. And that's just kind of based on the revenue projections that they are putting forward. Yeah.
I have a question, maybe not directly related to that, but so you're talking about 8 years perspective, right? Something like that. So you have to be quite futuristic about what's going to happen.
Yeah,
in the
crystal ball thing, kind of, yeah.
But usually when we see the pitch decks, they're talking about current issues, current problems, and that's appreciated usually that they find problem now. But after 8-10 years, it will be different. It will be future persona, future problem.
Yeah, that's why it's more of an art than a science at the end of the day, isn't it? So I would say you will probably evaluate 100 plus pitch decks before you end up with one investment you actually will consider and invest. So it's just part of the game.
But I'm feeling that usually what's appreciated is the identification of the current problem, not the future problem. Isn't that a challenge?
It is a big challenge. I would say it's one of the biggest challenges at the end
A
of the
question
day.
of how long the problem will stay
Yeah.
in the market. I know, Andre, are you reading any books that give you away like future trends?
No, I think nobody knows. Of course, like you need to be informed in general of what is happening in the market and what are some of the trends. But I think in the end of the day, the companies that are solving actual problems today, they will find a way how to stay within that same lane and solve future problems, right? And the product might shift a little bit, they might do a slight pivot, they might think, okay, how do we approach this? But I don't know, if you look at Bolt 10 years ago, everyone wanted, everyone was using taxis. They didn't think about ride sharing. And today, look at how the company evolved. They added Bolt Food, they added Bolt Drive, they added all these other additional solutions to their product offerings. So I think successful companies are the ones that are able to change with market conditions. And you need to look at the trajectory, and you need to look at what is happening today.
I also, I guess, an example would be, I know, Tesla. And they have, I think, one of the latest stories was that they're shutting down one of their car manufacturing facilities and transitioning it into robot manufacturing. So that's also kind of an evolution, I guess, that they probably didn't imagine themselves also years ago. Or again, I think this week there was a headline in US, a shoemaker brand is transitioning into a AI compute generation company. Yeah, it's like, like what type of evolution? Yeah. Yeah. Other questions? If no, then I guess round of applause as well.